Yeah, I'm Red. I'm a research analyst at Masari. Data is kind of the name of the game for us. Think of it as like the Bloomberg of crypto. We try to add some transparency to a space where, yes, it's all on chain, but it's sometimes hard to understand what's going on. And we've been talking a bit about RWAs. I'm going to put a hopefully unique twist on it so we can, get into some of their aspects of it. So I'll do a quick zoom out, look at DeFi, jump into RWAs, what they started as and what maybe the next evolution of them will be, and then what does that look like on the XRP ledger and in its broader ecosystem? Because it is no longer one network, it is a group of side chains, and we're getting some modularity in there, which is fun. Zooming out on the state of DeFi, in short, it is probably on Ethereum. If it's not on Ethereum, it's on the EVM. And we see that with ETH having a majority of the TVL. We see that with Tron, Binance, Avalanche, all these other networks that are using the EVM, similar to the Evmos client that is used for PeerSyst's EVM sidechain. And we're seeing that is where users and liquidity are. We are seeing $100 billion plus of total value locked on all of these networks put together. And that brings us to RWAs, which are very intertwined with DeFi. And the most popular RWA, which is stablecoin, is kind of the core of DeFi, and it helps a lot of it run. I don't think we'd be anywhere near where we are in terms of applications, users, and liquidity without that specific RWA. I'm sure you all have a good idea of what they are now, but yeah, let's take some off-chain assets, let's put them on-chain, let's tokenize them, let's get all those good things that we have about crypto, and let's have our real-world off-chain assets inherit them. The 24/7 trading, the democratization of access to these assets, the ability to fragment them and break them up into pieces, adding a different flavor of democratization. One is just being able to access them, but two is if you can break these things up, you can lower the price point, more people can get involved. Generally, we have two types, tangible and intangible. So when some people hear RWA, you might think of like a house or maybe like a Rolex or something like that. You might also think your TradFi assets, so US Treasuries and things like that. They both have some benefits. They both share some similar challenges. So what some of those challenges look like is, other than like commodities, we still have regulation involved. So when you think of on-chain assets, we're talking about decentralized assets, right? No one has a say in whether you send someone else XRP. That's completely up to you and the recipient. This is a sovereign asset. But when you deal with something that is regulated off-chain, the situation changes a little bit. So I've got a house, I'm representing it, as an NFT. And if I want to transfer that to someone, well, yeah, I can send the NFT, but if my local government does not recognize that sale, then did I sell the house? Like, no, we still have this regulation. We still have parties that have a say in it. It makes it an asset that is not completely sovereign. And that's the case with our stablecoins today. If you look at, USDC or USDT, you can have a blacklist of an address, and, there are some kind of safety features built in there. And, these are needed for regulatory reasons. And if you were the issuer, Circle or Tether, or with RLUSD, Ripple being the issuer, you want to have that control. You want to be compliant. So this changes a bit of what these tokenized assets look like compared to traditional crypto assets, which are completely sovereign and completely decentralized. And, you have full autonomy over your assets and what you're doing with them. Now, diving a little bit deeper into stablecoins, looking at the state of stablecoins today, $161 billion market cap. I've got a couple of charts here that show the meteoric rise of stablecoins outpacing some, popular TradFi payment rails, like a MasterCard, and then even Bitcoin, which, might be surprising as stablecoins are, almost secondary in the crypto world, right? Your native asset, your BTC or your XRP, is thought of as like, hey, this is the main course and stables are off to the side, but they actually do more transfer volume. And that happens in a lot of places, not just ETH, this happens on Tron and other networks as well. But, the bottom line is, and I hope the irony is not lost on you, that fiat money and the US dollar are super popular on crypto. I mean, crypto exists because, for a large reason, a lot of people were not satisfied with fiat. So we made crypto, and what do we use it for? To transfer fiat. We're kind of coming full circle here. Looking at USDC and USDT, these are the two largest and most popular stablecoins, and we're going to have a lot of diversity in stablecoins because we have different people that want different ones for different reasons. Looking at this chart here, we have some data from Coinmetrics where it just shows frequency of on-chain transactions, and that gives you a pretty good idea, assuming people are awake at normal hours, of who is actually transferring these assets. We can see that the West favors USDC. We can see that the East prefers USDT based on times of the transactions. These are not our only two stables. Probably the next largest one, or the one that was the largest after these, was UST, Terra Luna, and you probably have some bad memories of that one if you were involved because it exploded. And some people think that was because it was an algorithmic stablecoin rather than having a governed peg. I would argue the issue with UST was actually that it used endogenous collateral, and algorithmic stablecoins can actually work fine. So you can have different backings, whether your backing is fiat or BTC. You can have governed pegs. You can have a fixed price, $1. It can be floating, like RAI, where it's not actually fixed to one price, which, inflation is real, so the US dollar is not exactly a fixed price either. But there are a lot of permutations on what we can do, and we really have not cracked the door open on that yet. We're really just using the same kinds of assets. And what I have here is a case study on what happens to a DeFi ecosystem when stablecoins get introduced. And it's a very predictable pattern of what's going to happen in the ecosystem. I used Cardano as a case study because Cardano has a novel execution environment. It's not using the EVM. And Cardano had a couple stablecoins introduced, and its TVL exploded. And that is rather predictable in any environment, because what do people want to do with their money when they're getting into DeFi? Maybe they want some yield, maybe they want to lock it up in a liquidity pair, but you don't really want to be pairing two volatile assets, right? So the dollar is, it's the global reserve currency. It is the asset of choice to do your DeFi pairings. So once you have a stable coin and I can pair my XRP with something else that's stable, yes, this is interesting to people. Rather than them having to use a volatile asset and have to keep an eye on it, and people want escapes from volatility. So particularly relevant right now, as we just got an AMM live on the XRP ledger, but this is pretty common throughout ecosystems, and both of the stablecoins here are not fiat backed. Fiat backed, as USDC, USDT, and they're governed, is generally the favored type based on just TVL and usage, on what we see people actually like to put their money in and feel safe about. And that's not even the case there. In this example, this case study of a one-year look at TVL and stablecoin growth. Now, looking past fiat-backed stablecoins into other types of RWAs, because stablecoins are not the end. You think everyone's going to stop at spot. They don't want yield or anything. They don't want to get into some more interesting assets. Stablecoins are the name of the game in finance on-chain, but that seems so simple when you look at traditional finance, right? Like, if the dollar was the end goal, no, people want all these complicated investment vehicles, and they want to get fancy with it. They want to experiment with stuff. So, the dollar is really just the bedrock, the baseline infrastructure. We've seen growth not to the same degree that we've seen with stables. Said $161 billion in stablecoin value. So we're seeing growth, but not to the same degree yet. This is just showing some, a little 4x in some alternative types. And these are things like commodities. These are things like US Treasuries, things like real estate. And they're all kind of just getting their footing. the difference with some of these assets, remember I was talking before about, hey, we still have regulation, we still have entities that like they need to be pulled into the loop. You can't really do this without pulling in a local government that has a say in real estate. You need regulation and you need asset holders to be approved to be holding treasuries. So some of that foundation is being laid, and some of the early movers are getting into that. But what do we need for these new RWAs? What do we still need? KYC controls are one thing. KYC is know your customer. This is, identity really, and it could be, having to show someone your driver's license every time you want to get onboarded to a platform. Not really favorable, kind of against the cypherpunk ethos that bring many of us here. But there are other ways to do this. DIDs, decentralized identities, are one way. So, we're on this one. We're exploring it. We need on-chain issuers to get involved. If we have an ETF and I want to be able to buy that ETF on-chain, eat some ETF from Fidelity or whatever, well, either Fidelity needs to say, hey, I'm on board, I'm going to go put it on chain, or we need some intermediary to go and take Fidelity's ETF, custody it, and put it on chain themselves. So a couple ways to do that, but we need to warm up to on-chain issuers, which I think we see happening. We saw the Bitcoin ETFs get approved and well over $10 billion of net flows in less than 6 months, or maybe just 6 months now. So, TradFi is interested. We have this legitimacy from the U.S. government and from the SEC, which goes a long way with, reputable companies that want to be compliant. So we're seeing some more of that now. We also need compliance tools. I talked about, I just send you this NFT that's a house. It doesn't mean you own it yet because the blockchain says you own it, but the government doesn't think you own it. So, completely out of touch there. We need compliance tools. We need companies to be able to safely issue these things. And I mentioned there's a little bit of that with USDC. In a fully programmable environment where things are Turing complete, you can kind of set up your token however you want. So the double-edged sword of issued assets, issued currencies on the XRP ledger, hey, really easy to put this out, but you don't have that full composability. Luckily, we have a lot of enshrined tools that are ready to go on XRP ledger. So before, that would look like trust lines and kind of, deciding, hey, who can hold this asset, which wallets are not on the OFAC sanction list. And we have more recent tools like clawbacks, which, similar to that USDC part, this is just more of an enshrined feature of, hey, I need to take this money back because I don't want some malicious actor, using funds that I issued and tokenized on chain. And then institutional adoption, I will keep hammering that this one is not solved yet. Part of it is we need to make it easy for them. Institutions are not going to go do all this hard work and figure it out if they don't know if there's a future with it. But if it's very simple for them to do, if we have all the infrastructure in place, things like clawbacks, institutional adoption gets a little bit easier. Things like regulation, like the ETFs, it makes it a little more friendly to get involved there.